All right. Well, welcome everybody to our Financial Freedom Wealthy Wednesday. Excited to be here with you today. My name is Jolene, and thank you, Manette, for having us and putting this platform together. Manette, did you want to say a few words to get started?
Welcome everybody to the Zoom. I am so happy to have you here. I'm really glad to have Jolene, especially to teach us always. So today we are going to be focusing on financial information and how we can invest and improve on our finances. Unfortunately, my background is really noisy, so I'll be going silent. And please, I'll be posting the Zoom just like the other ones. I've posted them on our Canadian Travelers YouTube page. Go there, get educated with the past information because we are not going to be repeating one and the same information just because it gets boring over time. So there's education there about sole proprietor, incorporation, taxes, like how to prepare for your taxes, or financial information that will also help you and myself. So thank you all for being here. Listen, participate, and engage yourself. Feel at home. Thanks, Joe. You can take
Thank you
over.
so much, Manette. Yeah, and so you could actually brand this a topic called 3 Ds of investing, because I do feel like that probably puts a lot of clarity for people around investing. So I'm going to just open up. I'll start off with just a little introduction to investing and some of the sort of mindset around it. And so first I'll open up and just talk about the fact that a lot of times when we think about investing money, we get scared, right? We're nervous. We work really hard for our money. And I think a lot of times we need to make sure that we understand what wealth means to us. Okay, I'm always going to start off by talking about that because, you do got to get clarity as to like, when do you actually arrive? When do you feel like, hey, I'm wealthy? Okay. And that is different for everybody. Every single person has a different definition of wealth. But I do believe you need to start thinking about that today, especially if you're going to start investing, so that you're able to measure your progress. It's very important that you have, if you want to be here by a certain age, and the reason you want to be there is because it's going to give you X amount of dollars every month. You got to have clarity around that. We call that your financial independence number, which is like this amount of money that if you don't actually go to work, it still comes in. We call it fall out of bed money, right? You get up in the morning and there's money in your bank account. And I'm sure you could all raise your hands and say you would love to have some fall out of bed money, right? So, the first step, like I said, is being here and open to learn. I believe that's so, so important to take real initiative in your financial planning, understanding like why you're doing things, because when you have clarity, it really does give you that confidence, right? Next step, have a goal and a plan to get there. You need a very defined, executed plan to achieve your goals, right? Like, if we got in a car and I know that one of you is in Owen Sound right now and I'm in Coburg, imagine I just said I'm going to Owen Sound and I'm going to try to find, Nina, and you'd be like, I'd probably never find you. You know what I mean? You have to have an address. You need a destination, right? And the third step is you've got to do it. You've got to like stop the procrastination, stop the delaying, right? And really just start taking, even if they're baby steps towards the goal. I would say that starting sometimes is the hardest part, but once you have it in action, it kind of takes on a life of its own. Now, when we talk about investing money, there's always the like basic things that you want to have in place. And that's for a lot of you, you're travel nursing, and you're getting like windfalls of money. And you really need to budget that out. And the way you need to look at that is you got to put some money aside for an emergency fund, which is really about 3 to 6 months of income. And the reason you need that is because I know for some of you, you're on contract, and sometimes a contract will end and then you're sort of have a bit of a gap in your income. And you don't want to go through the emotional roller coaster of having lots of money and having no money. Okay. I do this a lot with real estate agents too. You want to find out what is your monthly budget? Like, what does it cost on a regular day to run your life? And then let's make sure that you're setting aside that amount of money so that when you have a month where you're maybe in between a contract, you have ease. You have some peace and ease in your life. Okay. And then we want to make sure that we've set aside money for those short-term goals. That would be like traveling, your gifting, your clothing, just those things that come up, even your fees for travel nursing and things like that. We want to dedicate money every month. Just set it aside, make it part of your everyday budget, because you know what? It's inevitable. We know we're going to have to pay for those things. And then we want to make sure that you always have a wealth account. Okay. Now, most people run into trouble because they'll put everything in their wealth account. Okay. And I would say your short-term account would be also your tax bill. That's why you want to plan your finances, because you want to know what you're going to probably have to pay at the end of the year. But that wealth account, if we keep taking money out of the wealth account because we got to pay the short term or we run into an emergency, then we're never going to reach our goals, right? So it's really important, even if you've got $100, put 50 in the emergency, 25 short term, and 25 wealth. So just getting that initiated and started is really, really important. And so today I'm going to go through something that I call sort of the steps to investing money. And really, this is a process. I know you're in nursing. So just like nursing, you know, you triage people, there's like a step-by-step process that you go through with a patient. It's the same thing with your finances. And if you follow these steps, you'll be successful. Okay. A lot of people skip steps. And I believe that's why they run into troubles or they lack clarity. Okay. So first step is you need a financial plan. You need to know, like, really exactly like I talked about earlier, how much money do you actually need, you know? And what sources do you have? Perhaps you are partially on track if you had a previous pension or you have some rental income, or whatever, your spouse has a pension, but you want to figure out exactly what the shortfall is for you to be able to retire. And you want to know what date that you want to be able to have enough money you don't have to go to work anymore. And then we want to go through in your financial plan a budget, want to look through, you know, your debt, your insurance premiums, all those things, trying to find some money that we can actually like start setting aside through your budget to dedicate to the savings goal. Okay. And then today I'm really going to teach you about the 3Ds of investing, which is, you know, as long as you practice, you know, and you use the 3Ds of investing, you will never lose money in the investment world. Okay. It's only when people actually don't have the 3Ds of investing in their investment portfolio that they run into those troubles at different times in the market. And then we're going to talk about choosing the best suited vehicle, the account type for your personal situation and your tax saving strategy. And it's really simple. There's only really a few accounts. There's a tax-free savings account, okay? There's an RSP. If you do have someone that has disabilities, there's an RDSP. There's a cash account, which isn't protected at all from taxes. And if you've maxed everything out, that's your only choice, okay? There's a new FHSA account, which is a new first-time home savings account, which works very similar to an RSP and grows like a tax-free savings account. So very important, if you have not purchased a home, that would be a great account for you to understand, right? That's where, coming back to step one in your financial plan, if you've actually said one of my goals is to purchase a home, well, that identifies to myself that, hey, we need to talk about the first-time home savings account. Now, in your financial plan, if you already own a house and you don't qualify for that program, well, then we don't need to learn about it, right? And then if you have children, your ESPs, okay, your education savings plans. So steps 1 to 4 is 90% of the conversation when it comes to your future. And 10% of the conversation is picking the investment, okay? Because once you understand the 3Ds of investing, picking the investment is just making sure that the investment you pick has all those 3Ds built into it, okay? So any questions so far? Sounds pretty simple. And you can always post in the chat too if you have a question. For those of you watching the video, you can always, I'll put my number and you can always reach out if you do have a question, okay? So let's go through we'll go into the next part, right? So the problem and why you need a plan, and I know this is review, but we're going to do this every time, is because the way we do money is it's all over the place. We have 5 to 10 different companies, got money going out all over, and we don't have a whole, like I would say, holistic approach to our finances. So having a financial needs analysis done will customize and really get all your ducks in a row, okay? Get all your information in one location, have you be able to really take a look at things and figure out, like, how do I find money to be able to invest and where do I invest, okay? Now, one of the things inside that plan is going to be determining that financial independence number. So a couple of reasons why you need to know this information is because inflation is something that really affects our finances, right? So if somebody said, I want $30,000 a month and I want to have that in 30 years, that's going to have to be $73,000 to have the same purchasing power as $30,000 does today. So we probably have some moms on here. It's kind of like buying toilet paper 30 years ago. It was much cheaper than buying toilet paper now. I just use that because that's across the universe. We all understand that, right? But the difference is $2,500 a month to buy things today means it needs to be $6,100 in 30 years from now in the future because of purchasing power. So one of the things we look at is what is your financial independence number? And it's different for everybody. No one has the same number. This is a calculation between your age, your goals, and that time horizon that you have to when you want to actually retire. But what the financial plan does is identifies how much money per month it is going to take to reach your goals. Now, given that you're doing travel nursing for you guys out there, this is a real opportunity for you to learn this information because you are making more money right now. So you can capitalize on being able to start socking away a good chunk of money towards those goals. Okay. So we're going to teach you what that looks like. And sometimes it just comes down to like playing a game with you. You know, I always say like being able to save $1,000 in 30 days. That's usually the first breakthrough that I like to create with people. That's that budgeting breakthrough of just getting into that mindset of your daily habits, right? So for example, you can play this game with a couple other nurses maybe, but you go, okay, well, listen, today the goal is to save $5. So this would come from maybe not buying a coffee out, you know, maybe getting a ride with somebody instead of taking the train. But there's different little things. If I'm consciously thinking about saving $10, or if I get a bigger item that's like $45, it could be just maybe canceling some subscriptions I don't use. It could be a bunch of different things, selling something on Kijiji. But the key is when we are doing this exercise, saving money is not enough. You have to take the money you save and put it aside. Otherwise, we just got cash flow. And I think that's the biggest mindset shift that we have to make is that like, oh, I got this on sale. Well, that's great. But if you didn't put the money that you saved yourself away, you really didn't, you know, save money. See the difference? We kind of trick ourselves sometimes. We say, I saved this amount of money, but we didn't put it away. And so all we really did, what we really should say is I gave myself more cash flow to go spend more money, okay, as opposed to saving it. So that's always like a good kind of reality check, okay, about how our money mindset goes. So that's the budgeting tip is just really getting consciously aware of every time we spend money, it's a choice. Is this a want or a need? Okay. And now we're going to jump in because I want to spend our time on this today because we try to keep these sessions about half an hour so they're nice and short for you. But understanding the 3 Ds of investing, okay? And there's 3 principles. The first one is discipline, okay? And when you have these 3 Ds, anytime you invest money, you will never lose money, okay? Because none of us want to lose money, but we got to make sure that we've got our 3 principles in place, okay? So discipline is staying focused and staying invested, despite what you hear on the news, from your friend, all those things, okay? And I'm going to show you an example of what I mean. The second one is dollar cost averaging, okay? And what this is this means you always want to put new money into the markets all the time because the markets are going to go up and down. I'm going to show you that, right? But if we are constantly buying into the market, then you're always going to you're going to buy at like more of an average cost, okay? Just like if you buy toilet paper, bananas, something that you enjoy buying, it doesn't matter if you like them or you need them, you buy them all the time no matter what the price is. Now, sometimes you get it on sale and sometimes you don't, but the average price works out better because on those sale days, it gives you a better average price, okay? And then number 3 is diversification, making sure that when you have your money invested, that you are in a variety of investments. You don't have, as people say, all your eggs in one basket, okay? Diversification allows you to capitalize on dollar cost averaging because, you know, somewhere in the world, something is on sale, okay? So if I'm investing all over the world, I get to take advantage of those, okay? And then I'll go into quickly a couple of differences between the tax vehicles that you can invest in, okay? Welcome, Margaret. Welcome, Sandy. So I'm going to bring you this book here. I do have a free copy for anybody who would like a copy at the end. You can just send me your email and I'll get that out to you. But this isn't called Investing 101, okay? And please, if you guys, I love you to be interactive. Just post in the chat as I bring stuff up. If you have a question or a comment, okay? But let's get to those 3 Ds of investing. The first one we're going to look at is discipline, okay? And in the discipline, I'm going to show you basically, this would be an example of sort of the charts. Now, there's something called a bull market and a bear market. And the easiest way for you to kind of try to remember those is a bull market. I always think of it as like charging ahead. And a bear market, you know, I would say people tend to run away from a bear, okay? Not that you should do that, okay, in this example. But I want you to take a look. These are the bear markets. These are the times in the market where you hear the media telling you that we're going into a recession, or you should cash out your money or liquidate it, okay? And then these up here are what we call the bull markets. These are the times in the markets where we have a steady increase. You'll see it here, okay? Now, I'm just going to check in with everybody here. Which has longer periods of time, the bear market or the bull market? Which has more, like, longer periods of time, the bear market or the bull market?
The bull market.
Yeah, the bull market. That's right. So the bull market is when the markets are going up. And if you look, this one over here, the one we just came off of, this was kind of like from 2010 all the way to 2021. Guys, this was over 10 years that the market had a consistent increase. Now, in the past 10 years, like that sort of decade, didn't you hear a lot of people telling you that the world was falling apart and it was crazy and COVID happened? And how many of you heard it was scary to be investing? Sure you did, right? Well, the truth is, if you didn't have your money in the market, you really lost out, right? That had a 195% increase if you invested money. That's a lot of increase, right? And if you look at the bear markets, these little tiny times in the market that the media is always like giving you so much information about, they're really lasting. Like this was 13 months, this was, 4 months, 12 months, 8 months. So they say the average bear market is about 9 to 10 months. And the average bull market where it's going up is over 48 months, almost 5 years. Okay. So when we talk about discipline, because that's what we're talking about, it's about staying invested. Okay. Now there are a couple things we're going to add to that concept so you make money, more money. But I wanted you to look at this. This is kind of like the evolution of someone who put in $10,000 and basically what happened over time. Okay. Now, this is all of the media stuff that you hear about. Okay. So this goes back from 1969 to 2020. And you're going to look through, you guys can see like a bunch of the different things, the tech stocks over here. But what I really wanted to pay attention to was the US recession. Okay. Because we hear a lot about recession. And I'll just tell you that recessions are inevitable. There's always going to be a recession. We're always either coming out of a recession, going into a recession. A recession is just a normalization of prices. Things that get too inflated, recessions bring them back to normal and then they build again. Okay, but it's always a new normal. And so I say that too because take a look at the trajectory. So over time, did this go up or down? Who can tell me? Over time, over the last, say, this is like since 1969. So this is like over 50. What did it do?
It went up.
It went up. Yes. So it always went up. So you know what? It's just like the housing market. If you think about real estate prices go up and down like crazy. But when's the best time to buy real estate? Anytime, because we know it's going up at some point. Now, there are different times in the market where you're going to make more in the market. You want to be smart about real estate. But the truth is that being disciplined and staying invested for the long haul, as opposed to getting caught up in the emotional roller coaster, is gonna save you a lot of agony, okay? Because all these times in the market where there are these little dips, so to speak, where they're talking about it, all that should give you is feedback. When you hear the media saying recession, the stocks are going down, like that's when you want to buy. That's the opportunity for you. That should instead of you running away from it like the bear market, you should run to it. You should go, hey, this is an opportunity where I get to go buy on sale, okay? And to give you a sort of an example of the second D, which is dollar cost averaging, okay? I'm going to take you through an example, kind of a fun game. And so this is it to demonstrate dollar cost averaging, okay? So we're going to say that, we got Sandy on here. We're going to say, Sandy, you're going to invest $100 every month, okay? And we're going to do this for 7 months, okay? And what happens is that in April, so we're going to say we're starting this in April, and I'm going to say, Sandy, that you're going to buy some shoes. Okay, we're buying shoes because I noticed we have all ladies on here. Okay, so we're going to say that for April, the shoes were $100 a pair. So how many pairs of shoes does Sandy get? 1. Okay, in May, the shoes went down to $50. Woohoo, right? She gets 2 pairs. Okay. In June, they're going to go up to $75. I don't know how you get 1.5 pairs, but we're going to just play the game. Okay. Then in July, $50, you get 2. August, back up to 100, back to paying full price, right? 100. But look at September. September was like, call your friends, start the car, right? Sale. So you bought 4 pairs of shoes. Okay. And then in October, back to 75. So that'll even out. You'll get 3 pairs that way. So in the end, okay, I know we're just joking around and we're buying shoes, but this is how investing works. Because shoes, you could say AKA shares, okay? How we actually make money is the number of shares that we own, okay? And I'm going to try to help you not get caught up in the emotions of investing, because I'm going to say that you got a statement. Let's say that, you got your statement and it was basically, we'll call it November, you received a statement. And your statement said that the share price was $75. And so how you look at the value of your money, it's the number of shares times the share price. So, let's say that Sandy got her statement and that was in November, and it said that she had the value, the book value of $975. Now, Sandy loves her financial advisor. She's like going to take her out for lunch. She thinks she's the best thing ever because remember, Sandy only invested $700. So she's positive $275. So she's like, this stuff is amazing. But then there's another situation, okay? And another, let's say that, who do you got? Minette got a statement. And her statement said that the share price had dropped to $25. So she gets her statement and she still has 13 shares or pairs of shoes, right? They're $25 each. So her book value says it is $325, which means she put in 700 and it's saying it's only worth $325, which means she's lost, this is what she thinks, she lost $375. Now let me ask you a question. Did Minette lose her money? Really important. Did Minette lose $375? No, that's right, Margaret, because she's not selling right now. So if Minette gets a statement and it says minus, like she's lost money, what should that tell Minette to go do? Minette should get excited. What should she go do?
More.
Go buy. She should be like, that's an indication like, oh my gosh, my shoes are on sale. Call all my friends. Everybody buy the shoes. Everybody buy the shares, okay? As opposed to, oh my gosh, I don't like my financial advisor. I'm going to cash everything out. That's the worst thing you can do because you're actually going to feel the loss because you're going to sell low. So think about the housing market, right? Would you rather buy houses when they're on sale or when everybody's multiple offers? And you'd rather buy them on sale, right? So I don't know what happens, but somehow when it comes to real estate, we understand this, but somehow when we come to investing our money, it's like we lose the whole understanding of what we're doing here. Because over time, all I care about, all that I look at, so whenever I have a client call me and they're upset about something, I just go, listen, how many shares do you have? And as long as they can see that they own more shares, we're happy. I don't care about this, doesn't matter at all, especially if you've got 25 years before we're needing this money. I would much rather accumulate shares at $25 a share. So I'll be like, buy more, okay? Because the way you make money in retirement is however many shares you own, these companies pay you something called a dividend, okay? And a dividend is kind of like rent. It's like, okay, I own some Walmart shares and Walmart had all these profits and they have to share their profits with me, okay? So if I have 13 shares, and I keep growing that, and maybe now I have 1,300 shares, I get more and more dividends because I get dividends based on the number of shares I have, okay? So I want to, in the accumulation phase of wealth, I would like to accumulate a lot of shares, okay? And so I say that too because here's back to the D's of investing, okay? Remember what's the third D? Does anybody remember? Third D. What's the third D? So we got discipline, we got dollar cost averaging, and then what's the third one? Don't you remember? Diversification, okay? So let's take a look at diversification because remember, dollar cost averaging means that, so if you set up an investment, okay, what you want to make sure, so back to here actually, is that the best way to dollar cost average is if you are going to dedicate $100 a month, for example, then split it into $25 per week, because then you take advantage of all these. We don't know when the market's going to go down, but if I have more money going in consistently, then I'm going to have a better chance of buying things on sale, okay? So dollar cost averaging is making sure that you're putting money into the market as frequently as possible. It's not trying to time the market. Anybody who's trying to time the market, you'll lose opportunities because by the time you know it was a good time and they're talking about it, it's over, okay? So don't try to time the market. Do like what we talked about earlier, set it and forget it. Get a plan consistently of money going, okay? And then when we look at the diversification part of it, okay, we're going to take a look at this. Okay, we're going to see who is paying attention. Okay, whoops, one back one. There we go. So this is an example from 2008 till 2021, just to give you a little hint. Okay, there is down here a little like key chart, okay, which tells you where we're investing. So I want you to know that at the bottom here would be, they say the worst, meaning the lowest prices. And then this would be the best, which would be the highest prices. Now, best and worst is irrelevant, but if you're selling, it's the best, okay? But at this point, we're accumulating. So we would like to buy in the lowest, or in this example, the worst pricing, okay? So who can tell me what was on sale in 2008? What was on sale in 2008? So I'll give you a hint. It's right here. Okay, and it's over here. Canadian equities, right? Guys see that? It was minus 33. That would have been like a sale. You would have bought so many shares if you were investing in Canadian equities in 2008, okay? But let's hop over to 2011, okay? And now what are we buying on sale? Okay, give you a hint. Asian equities, okay? So investing in Asia. Everybody can see that? Okay, let's move along. How about, what about this one? What are we buying on sale here?
Is it a European equity?
European equities, that's right. So investing in Europe, okay? So again, this is just to give you that example, right? Like you want to be investing all over the place. Now you probably noticed the US equities tend to do quite a bit better, but even here, like that year, US equities in 2008 were minus 21. So again, if I have my portfolio, let's say my pie of money, okay, and I have it invested all over the world. I've got some, Canadian content, some US content, Asia, Europe, and of course, we always want to make sure you've got some fixed income so that we can put some security in there. But what happens with an investment is typically they're made up of 100 to 150 different companies, and the asset allocation you want to make sure is diversified: US, Canada, Asia, Europe, right? Because if I'm putting in my $100, it's buying a little piece of every single country, every single place, right? So somewhere I'm buying on sale, and I can't know what's going to be on sale. All I can control is putting money into the market. Okay. So that's diversification. So if you want to win the game of money in investing, number one, you got to stay disciplined. So don't get caught up in media, and don't get caught. Usually the media puts out stuff to get movement in the markets. Okay. So you got to be careful about that. Second thing is you want to be dollar cost averaging, putting more money in consistently. And the third thing is you want to be diversified. You want to make sure, like, if I pick up a portfolio and it says, 100% Canadian content, trouble. You're going to lose money, because guess what? Canada is only 3% of the entire world economy. Okay. And so, US is 48% of the world economy, and Europe and Asia, the rest. But you got to make sure you've got money all over the place, every single country, because that way, you know what? If Canada's down, I'm buying on sale. If the US is down, I'm always, out of the 4 places, somewhere I'm going to be buying on sale. And that's what you want to do, because you're accumulating shares. Okay. So just to this book is a very handy book. Happy to send you a copy of it. And just to kind of touch base on those, as we roll out the last couple minutes, when we talk about the types of accounts that you want to be able to set up, I'm just going to touch on this. I think I'll spend next week going in a lot more detail about it. But listen, RSPs are an opportunity to save on taxes. For some of you guys are, you're in a corporation and you're paying yourself a T4 income, like an employment income. We can use RSPs to help you reduce your taxes. That's one thing we can do. Okay. If you're self-employed, sole proprietor, and you're getting your income pretty low because you're writing everything off, a tax-free savings account is going to be where we're going to build wealth. Now, I believe that if your income is low, right now you have over 94,000 of room in your tax-free savings account. Let's capitalize on that, because you can always move money from your TFSA to your RSP if you work with your accountant and they say, hey, listen, if you put some money into your RSP this year, it's going to help you. We can always shift money from a tax-free savings account, cash it out, and put it back to the RSP. But if we put money in an RSP and we don't really need it there, it's a taxable income if you have to take it out and move it somewhere else. Okay. So I would just say that we will spend some time really understanding where is the best place for you to invest your money. Okay. And why that's important, and why, just as we sort of like close out the meeting today, is understanding that when you're doing this, let's go back to the beginning, go back to here. These are the steps to getting yourself set up financially. You had your accountants on Fridays. I know they'll be back again this Friday. The financial plan is going to help us understand your tax bill, which then is going to help us understand what vehicle to invest your money in. And it's also going to help us look at your budget and all the things you're doing to see where we can cut back money to be able to put money into these investments. Okay. You're all experts now on the 3 Ds of investing. So you got that handled. Okay. And then, like I said, this will be our next step: financial plan, budget, pick the account, and then we can really dive into like, what is the best investment option for you? Okay. So that's good for me for today. I'm going to open it up if somebody has a quick question, and I will post my information if you would like a copy of the booklet, as well as if you'd like to set up a time to do your financial plan. Those are free. I'm happy to do that for you. Any questions? Comments? Did you learn something today?
Sorry, Joe, to pass on my message. Like, this Zoom today, I can say I've really, really learned a lot, because I've been longing to learn the information about stock and investment. And yeah, I'm really happy that at least you gave us a what it's like the tax where people can invest out of Canada. My God.
Oh, we're losing you a little bit, Minette, but I think we kind of heard you. Yeah, just send me, just text me. I know, Nina, you said you'd like a plan. Text me your, like if you can on my phone number there, just text me your email. And if you'd like a plan, just say like a plan. And that way you and I can set up a time, okay? So my number, if you are listening on video, 647-444-6529. Just let me know that when you text me that you are from the travel nurse group because you get preferential treatment, okay? I always make sure we squeeze you in at any time of the day that it works, okay? Anybody, and if anybody would like a, yes, the difference between the RSP and the TFSA, Margaret, 1000%. So that booklet that I have, it does go through the differences, but truthfully, I've been doing my business 19 years teaching people about money. Until we look at your finances and you understand which one's going to benefit you, that's when it makes the most sense. Probably most people misunderstand the tax-free savings account, and they do misunderstand RSPs. They have RSPs when they don't need them sometimes, and then they don't have a TFSA when they really do need one. Yeah, perfect. Yes, Nina, can you text me, Nina? Just text me your name. That way I'll have your number. We can go back and forth with the, you've got my number just above there. Yeah, anybody else? Any questions? What's your one takeaway? What's one thing you took away today?
My question, Julie, sorry.
Yeah,
My
Margaret?
question will be, you talked about how we invest into the market.
Yes.
Yes, we cannot monitor this market ourselves. That's why we have our financial advisors or our investors, right? So our investors should be able to know our risk factor and invest this money to the market. All we need to see is to see our portfolio growing.
That's
because truly speaking, like you said, honestly, I never, if my take home today will be try and put money on, be consistent, even if it's
be consistent.
just be consistent. That's what I'm taking home today.
Yes.
But our investors should be able to navigate those markets for our interests, because like you say, really have the time to say, okay, what's high today, what's low today, what's high today, what's low today, isn't it?
Right. Yeah, that's right. And that's what you hire like portfolio managers for. That's what they do. But mutual funds, they deal with billions of dollars at a time. The challenge is that a lot of people invest and they're not diversified. Like, I mean, a fund manager manages, like if it's a Canadian equity, the fund manager manages that. But when you're building a portfolio for somebody, you've got to make sure you're not just doing Canadian equities. You need to have it's a fund of funds. You need to make sure there's Canadian equities, US equities, Asian equities, right? So that's the part of the client where you can really it's almost like supervise your portfolio, because you can go check, check, check. Okay. Am I putting money in consistently? That you control, right, Margaret? But then, hey, when I look at my asset allocation, am I too much invested? Like, for example, I meet people and they have half their portfolio in Canada and only a little bit in the US. And I'm like, well, that makes no sense, because Canada is this only a little portion of the world economy. So, if you have so much in Canada, you're missing out on all these 48% of what we spend money on.
Makes
right?
sense.
Yeah.
Thank you.
So Mark, if you would like a copy of that book, just if you haven't sent me, just send me a message. Just text me to that number and I'll get you the Investor 101 book. Is really good just to have as a resource.
Okay, I'll text you in this number, right?
Yeah, 647-444-6529. That's right.
What do you want me to text? Email or my phone number?
Well, if you text me, I'll have your number and you can send me your email in that, because then I'll be able to forward you the booklet out, okay? It's great. Awesome, ladies. Well, thank you. It was nice to meet everybody.
You too. Thank you. Well appreciated, and it was a good lecture. Thank you.
You're welcome, Sheila.
Thank you. You teach us
See you next
about
Wednesday.
tax-free RSPs.
Yes, next week we'll dive in, but it's kind of like that's the most important part today, is getting that first step. So we'll dive into RSPs, TFSAs, FHSAs next week, okay?
Okay, thank you.
Yes.
Actually, I do have a question.
Sure.
Are you able to add QuickBooks to your teachings?
You know, QuickBooks is not my specialty, Sandy, because I'm
Okay.
not an accountant, but I know that we could, I could offer that information to Tanya and the other accountant and ask if they can touch on that for sure.
That would be great.
Yeah, so good, Sandy.
Yeah.
Did you
Thank
learn
you.
something today, Sandy?
Yes, I did.
Okay, very good.
All right.